Hey guys, I'm Keith Jennings, the Chief Strategist over here at Jennings & Associates Financial Advisors. I want to bring you a concept, a foundational concept that I believe and our team believes is absolutely key to long-term success, not just in investing, but anything you pursue that's worthwhile. And I wanted to share some ideas and concepts around that supporting theme today. As the markets have a lot of turmoil, stocks are down, bond prices are down as interest rates rise, and the government's trying to get control of inflation and runaway prices. I don't think that's wildly unexpected for most professional investors, but at the same time, we all have to contend with what do we do? And I think that's a common question and a good question for most investors out there today that are preparing for their retirement or managing their retirement. So ultimately, I want to share a couple concepts. For most folks today, I think that you're going to interact with, be it a family member, a friend, a coworker, even an advisor, they basically are going to have three options or lenses to see the world of investments. And I think it's important first, before you make big decisions, that you look through and understand the lens in which they might be seeing the world. And one of those ways that we can see anything, any event, anything that happens to us or that we're engaged in is obviously we can have a pessimistic lens to look at and see the world. And that's not uncommon. A great many people we encounter and engage are negative. They see every event that happens as an assault, and ultimately have the emotions and physiological and psychological response to go to battle. They're ready to fight, they're ready to argue, they're ready to debate. And ultimately they bring a lot of negativity to whether it's the work environment or the discussion or the planning experience. They're just pessimistic. It's generally not healthy, and ultimately when it comes to looking at the lens of stock prices, of bond prices, over time, normally, particularly historically, pessimists have been wrong when it comes to the overall averages. Stocks have generally risen over long periods of time, especially indexes that are well diversified. So pessimism, as a general rule, has been really expensive. The other end of that pendulum really becomes optimism. So for folks that say, I don't want to surround myself with pessimists, I completely get it, I'm in that camp. At the other end of that spectrum, though, is folks that generally swing, or that pendulum swings, that they want to see rainbows and rose petals everywhere they go. They look for opportunity in almost everything. And while that's great, it also has some material costs when it comes to being a professional long-term investor. And ultimately, it can be costly because if everything's an opportunity, nothing is eliminated from consideration, and we end up finding that we're a buyer of everything, and we are diluted in not only our investment strategies, but in life as a whole. We end up buying quick fixes, we do those things, we're looking for opportunity that oftentimes just isn't there. So in both of these cases, being a pessimist or an internal optimist on everything is ultimately a behavior that we need to consider the lens in which we see the world. As it relates to quality, consideration, and thought, and being a thought leader, I think most important as you think about your investment planning, being a realist, understanding that markets go up, markets go down, that it is somewhat difficult, but you got to persevere, you got to have a strategy in place is a key attribute to long-term success. So considering pessimism, considering optimism, how do we balance those two? We ultimately get to this position of realism, that life can be difficult, but it is what it is. And we have to have strategies and systems in place that can endure. So as you have the next discussion with a coworker or family member that talks about the world coming in from an investment standpoint, or someone that sees nothing but opportunity, I think the truth of the matter is that both have some reality, and you have to sort through that consideration, oftentimes with some distance and a help. So what does that mean? Well, ultimately, your behavior, the one thing that will drive your success more than anything else, far more than your advisor, far more than what the indices do or don't do, is how you react. It's your behavior, it's your activities, it's your habits. So the keystone to success is how you engage. If you're always if you're a pessimist in everything you do, you're never going to find opportunity. If you're always an optimist, you're going to fall in a lot of traps. If you're a realist, ultimately you can consider both of those two, weigh the options, have some distance, and manage your behavior. That's critical to long-term success, not just in investing, but in anything material that we do in our life. So behavior is a keystone. I'm by trade a behavioral financial advisor. That means I help folks contend with both advisors and clients. The biggest difficulty most of us have is controlling and managing oneself. The next thing we have to do, if we buy that is all within our control, our agency, is we have to have a method, a methodology, something that's repeatable, that when difficult things happen, we are prepared. Here at Jennings & Associates, we use the GPS method. It's goal, plan, strategy, and if you work with us, you've heard us time and time again talk about buckets, which are spend, save, protect and pivot, and grow for your goal. Those three buckets allow us to manage our behavior, let stocks do what they will do for the long term. They will go up, they will go down in indices, as will bond prices. And that middle bucket allows us to pivot depending on our personal circumstances and our needs and the market opportunities and or difficulties. The final component that I think is absolutely critical after you've assessed your behavior, you understand that you're going to either need to work on that to be successful, you have a methodology in place. That third component that's absolutely critical for most of us need help with staying accountable. We use a checklist here to help keep our clients on track, to help keep you on track. If you're our client, you got to work the checklist, even when it's difficult, even when stocks or the overall economy is in a bit of a decline like it is presently. Work the list, stick with the methodology. It's key. And ultimately, too, is find someone, if you don't have it, that will hold you accountable. Keep your feet to the fire and as it relates to your behavior. Allow you to see if you're being too pessimistic, too optimistic. Are you in that zone of realism? Do you have a methodology? Are you ultimately going to continue with that methodology regardless of what spins around you? And is your advisor an accountability partner? Because that's really the key. This idea that advisors can predict what is going to happen, I tell you, I think that's a bunch of hogwash. Nobody knows whether interest rates are going to go up in the next meeting or down, or the stock market go up or down. There's too many variables at play. But what good advisors can do is have a plan in place with you and work it for you and hold you accountable to those activities. So, hope you continue to work towards your meaningful goals and find a partner that has a good method and holds you accountable. Thanks.